Oh my gosh, S&P Global PMIs and ISM services. This is a disaster. This all comes after the employment change data, and now we're getting reports that consumers are starting to flip-flop as well. We had a lot to talk about in this video, and the only thing that's making it remotely better is that you can get 25% off with Shortform. Shortform.com/meetkevin. More on them later. But listen to this, folks. ISM services, the expectation was 54.4. We got 51.2. Big drop on the services index there. Very big. I mean, we were at 55.1, 54.4, small drop. And then we went boom off a cliff, almost contractionary there for services. Remember, a number under 50 is contractionary. And what does the Fed want to see? Disinflation in services. Well, it's coming. But the problem is, how many EPSs, how many companies' earnings per share are going to get devastated in the meantime? I don't know. That's just the ISM services indicator. Now I'm going to give you some examples of companies in just a moment. But ISM came out along with S&P Global Services today. S&P Global Services PMI tells us what? We were at 53.8. We were expecting to be stable at 53.8. No, we also missed 52.6. Everything came in a little oopsie-doopsie today. Mortgage applications came in worse than expected. ADP employment came in worse than expected. We've got the jobs data coming out on Friday. Look, let's talk about consumers. Let's talk about what's going on with consumption, how this could hit EPS, and which companies might start seeing cutbacks, because it's a warning, and these numbers just contribute to that warning. Let's go. We know consumers make up over 2/3 of the economy, and one of the things I love paying attention to is what's happening at the edges and the fringes. What's happening with poorer spending and what's happening with richer spending, because it gives us an idea of where people are starting to cut back. And there are two areas we're starting to see cutbacks where ordinarily you don't want to see them to keep a good bull market going. And in this case, we're going to look specifically at corporations and richer household spending. So let's jump in with corporations, then richer household spending. But first, let's understand what Barron's thinks is happening in terms of corporate spending. Take a look at this. Here's a piece on companies see a slowdown ahead, and this figure tells the story. So let's take a look at the story that Barron's is suggesting. So first, companies are tapping the brakes on capital spending as they anticipate cooling demand. That's not great. They are conserving cash as they prepare for a tougher economic environment that might be prudent on their part. And good news for shareholders. After all, good news for shareholders, when a corporation cuts back, you temporarily see a boost to operating profits, right? But what if they're cutting the potential investments in their business that actually let them continue to see growth? This is actually a very important thing to consider when you're investing in stocks is, wait a minute, it's fantastic that the company I'm investing in is cutting their SG&A expenses, their selling, general, and administrative expenses. But if they're cutting selling, are we potentially robbing from the future growth of the company to have a higher margin now during potentially a weaker time? And often the answer is yes. Now, in many cases, there are also companies that just take advantage of the layoff cycle of a recessionary environment to get rid of poor performers. This is very normal as well. After all, think about it. Companies don't want the reputation of firing poor performers, because if people regularly get fired, it makes it harder for a company to promise job security to new employees when they come. However, if a company can throw up their hands and say, whoa, recession, sorry, man, we gotta cut back. We can't even offer the food we used to offer anymore. Sorry, we gotta lay off a bunch of people. Generally, not always, okay, not always, but often the first people to get laid off are the poor performers that if a company had a firing policy would probably be fired anyway. There are a lot of companies where people would actually be really hard workers in, and they'd look around and go, this is so frustrating. There are other people putting in 10% the effort I do, yet they get paid the same amount. But the companies don't have a policy where they can actually fire people. So they wait for a recessionary cycle, and then they go through the weeding cycle. It's not saying everybody who's laid off is affected by that. Just saying, It's a very common thing that corporations do. So, in this same weeding cycle, what is Barron's telling us? Well, they're actually saying that companies may be cutting back on CapEx substantially based on the charts Barron's is looking at. And that could be a red flag for companies that sell heavy equipment or technologies and systems used in CapEx. Now, the first thing that I think of when I think of heavy equipment is I think of the investments that farmers were making during the inflationary cycle after the pandemic, during the supply chain crises, for shipping, but also for food, like farmers for even wheat after Russia invaded Ukraine, or other food products that exploded after the pandemic, such as even chicken. And so heavy equipment that goes into farming or industrial manufacturing or even the processing of meats, I think a lot of that heavy equipment was purchased and invested in during the pandemic or commodities bull run cycles. And that may get reined in now. So I'm looking Caterpillar, John Deere as potential red flags here. But I also scratch my head and wonder, well, what about ASML? Are they going to produce less chip manufacturing equipment? Well, Barron's actually gives us a little bit of insight into this. Analysts expect aggregate CapEx for companies on the S&P 1500 index to rise about 7%, just over $1 trillion this year, according to Citigroup. That's down from a 21% increase in 2022. That's about a 1/3 as much growth. And it really kind of matches inflation. It is expected to rise just 2% in 2024. Now, this I think is interesting. One of the biggest things that I personally have learned during this cycle is that things take a lot longer than normal to adjust. It takes a lot longer than you'd expect for the market to bottom and for things like inflation to actually go away. That patience is frustrating, but it's also good for planning, because if we're at the beginning of 2022 and we're thinking, all right, recession's coming within the next 6 months, but it actually potentially takes 2 years, it would be good to plan for that potential heads up. Now, weakness is expected in more economically sensitive sectors, or those that see sales rise and fall with demand, economic demand. The consumer discretionary sector, which includes retail, restaurants, and hotels, is likely to see CapEx drop by 3% this year. Now that's interesting because retail, restaurants, hotels, and the like, which would include airlines, would make you wonder, wait a minute, is it possible that that booming segment where jobs and wages are growing so strongly in retail, restaurants, airlines, hotels, hospitality, is it possible that those companies are going to rein back their expenditures on coffee machines, new stoves, new equipment for their airplanes, whatever, as they try to maintain profit margins and as they start seeing competition at the top where they can't raise prices anymore? And the answer to this is likely yes. Quick note before we continue, reminder to check out Shortform, where you can get super-powered book summaries to encourage you to potentially check out the entire book. My favorite is Jim Collins. You can get phenomenal insights on running a business through this app. Shortform makes it so easy for you to explore different book titles of different genres and get inspiration. My goal is 1 short form a day. Check it out, join the challenge, and go to Meet Kevin. Shortform.com/meetkevin, or just go to meetkevin.com and you can see the links there on the website. Consider, for example, what Darden, the company that runs Olive Garden, for example, is doing. They're talking almost solely about efficiency and productivity and doing more with less. Back a year ago, all they were doing was bragging about how they could raise prices. This conversation and narrative has completely turned on its head. Now, all of a sudden, the companies are realizing they're in a situation where they're looking at the scoreboard and they're going, uh-oh,
lost the lead.
That's not good. They don't want to lose the lead. They want to stay ahead, but they don't have PP anymore. They don't have pricing power. So what do? They stop investing in their business in new equipment to try to maintain margins to appease their shareholders. Excuse me. That is really borrowing from the future and giving to today. Because if you don't continue to reinvest in your business, your sales will probably suffer in the future. It's one of the reasons I'm personally bearish on retail and hospitality and travel. I understand there's a boom in that now, but I'm bearish on it because I don't think it'll last. In fact, before we continue with this Barron's piece, I could tell you that there are already red flags that some of these sectors are starting to get hit. Look at this. Here is a piece from Bloomberg talking about hotel rooms over $500 a night are too much even for rich travelers. And they talk about here, this may be a reflection of diminishing consumer confidence that inflated prices have not been accompanied by a proportionate increase in service quality. See, this actually directly relates to the Barron's piece and the argument that I'm making, where companies are starting to cut back to maintain whatever margins they have. They can't raise prices any more than they already have, but then people are going, what the hell? I'm paying a premium and y'all aren't even keeping up with expenditures and investments into your own business. The service is actually getting worse in certain cases, despite you paying a premium for certain products. The results come during what should be one of the busiest periods for travel booking. March is when people start finalizing summer plans and early birds get a jump on year-end holiday reservations. Okay. However, some 69% of poll participants said their maximum budget per hotel room was $500, while 24% were willing to spend $1,000. Still, 5% set their limit at $2,000 and 2% were willing to spend $3,000. Respondents include traders, portfolio managers, senior managers, and retail investors. Although $500 to $1,000 might seem high, the range eliminates the fanciest hotels in major markets. Okay, so they kind of give a little bit of a breakdown here of this survey. And here is where they suggest a difference. I'm always interested in the delta, the difference of what's going on. The results of the survey suggest that luxury hotels, restaurants, and airlines will face increasingly irritated customers or consumers this summer. I don't even want to talk about how disgusting some hotels have gotten in that COVID's over. And they're still saying, yep, sorry, no room service, COVID. And I'm like, this is bullshit, It's crazy. Anyway, bank failures, fast inflation, elevated mortgage payments, and the softening labor market, especially in the high-income sectors such as tech, could see tourists keep discretionary spending in check. This is a shift. We wrote a little note here. This is a shift from what we heard from American Express, where individuals were still spending through the recession. That was in the American Express last quarter earnings call. And American Express appeals heavily to white-collar and higher-income individuals. So what's important about this? Well, what's important is we're starting to see complaints at the margin, at sort of the right side, the right tail, maybe the higher-income tail, where people are starting to go, okay, starting to run out of money here and starting to have to pull back. In my opinion, that's negative, not just for the companies that would be investing in CapEx, like we were talking about, the hotels or airline manufacturers, but it's also a red flag that not only are we going to start seeing some of that softening at the lower consumer end, where we're probably going to see most of the softening and most of the hit, but we're starting at the margin to see some hit to that discretionary higher income phase. And that's something to pay attention to as well. This is why I always encourage people, make sure you have some kind of side hustle where you're making additional income. In fact, if you want to make YouTube videos, the easiest way, in my opinion, to do that is check out StreamYard. StreamYard is awesome. It's a fantastic platform. It's a sponsor for this segment. And they're a great platform where even if you're not live recording, you could use a web browser to record yourself. Just go to metkevin.com/StreamYard to learn more. You could use a web browser to record yourself and actually pop up different windows or different banners, and realize you could record your presentations, download them in HD, edit them even within the browser. Don't even need editing software anymore. They do it with you. So check out metkevin.com/StreamYard. It's been a lifesaver for me for the past few years, especially since I'm traveling so much. There's this mention here in Bloomberg that retail investors see positive airline share drivers, but institutional and professional investors actually think the airlines are going to get hit pretty hard based on a lack of potential CapEx spending that we're starting to see at some of the airlines. Going back over here to Barron's, look at this. The reason companies are watching their big ticket spending is because they're preparing for more muted demand and profits. There used to be this story that my father-in-law used to tell me. He goes, hey, Kevin, there's this story about this father who ran an antique shop off the highway. and the antique shop was doing very, very well. It was like 2021, right? The antique shop is killing it. It's got growth. Its income is going up. Everything's fantastic. It's spending money on advertising. It's growing. It's going great. And then the son, who's college educated, says, well, Dad, don't you realize we're going into a recession? You should cut back. And so the father-in-law says, oh no, or the father said, we're going into a recession. That's terrible. Well, we better cut our spending. Let's cut our spending on that billboard that we have at the corner of the freeway that says exit here to our antique store. Let's not spend $1,000 a month anymore on that billboard because we need to prepare for the recession. And so they cancel the billboard. Sure enough, people don't come to the antique store anymore because now the billboard is gone. And all of a sudden, income falls for the store. The father's like, my gosh, son, you were right. We're going into a recession. And the point of the story is to argue that, good Lord, some of the recessionary impact of the economy that we're in can very much be self-fulfilling. When businesses cut their CapEx spending, they can induce their own recession. Now, this is exactly why. And I try to be really neutral here. I'm just going to put my cards on the table and go, the reason I selected the cards that I did is because I think the cards that I chose, the stocks that I chose, are basically businesses that not only have pricing power, but are going to continue to invest in CapEx and growing their businesses during the recession, whereas other businesses are cutting. So I think consumer staples, restaurant, retail, hospitality, all of those, and even the industrials like the Johnson & Johnsons, the 3Ms, I think they're all looking at cut. All of them. Because they're self-inducing basically their own recession. Whereas I think the companies that are not are first of all the ones getting the stimmy checks, but second of all the ones that are basically the growth companies of the next decade. The energies, the chips, certain electric vehicle manufacturers, right? Those are the ones I think have pricing power because first of all, they're getting massive stimmy checks from the government. That really helps you continue to spend. And if you continue to spend, you continue to grow and you don't self-induce your recession. Think about it for a moment. If you're that antique store, except instead of selling antiques, you sell solar inverters. And the government's like, hey, don't cut back on spending. Here's billions of dollars. Here's a fire hose of stimmy checks. Please keep investing in your business and spending. Those businesses are going to be like, all right. Like, I hate to call it like stupid proof because obviously I can't guarantee it. But I'm just saying, if I could shake people and go, come on, it's obvious. Go where the stimmy checks are going. Anyway, so let's keep going with this Barron's piece here, and then we got to get to that corporate Lashup. The reason companies are watching big ticket spending is because they're preparing for muted demand and profits. The Federal Reserve's interest rate hike started last year, but usually reduced demand and inflation with a delay, so companies have only begun responding as they reduce large investments once they see the beginnings of destruction to demand and sales. In fact, Citi data shows that in the past few months, banks have tightened their belts on lending as a result of consumer and business credit worsening, which should curb demand. Now, I'm actually surprised that we've actually started seeing some tightening on this because the banking crisis, according to NatWest and many banks, hasn't really started yet. But then again, they're talking about the past few months. So it is true that we have seen if the line is down, like if I invert this, usually tightening credit standards is an up line. But if you invert it, it just psychologically makes a little bit more sense, like less availability of credit. The credit tightening has kind of been doing this anyway. I think there's this anticipation that the bank crisis would lead to more of a drop-off, but that hasn't happened yet. But yes, overall, larger banks have been tightening over the last year. Okay, so this reinforces stagnating earnings growth concerns. Stagnation is oftentimes what leads the stock market to turn red. The good news, though, is according to Barron's, the stock market has already reflected much of the economic challenges, and the S&P 1500, while above its low of the bear market, is still down 14% from late 2021's record high. The other good piece of news for stock investors is that lower CapEx means companies have more flexibility as to what they can do with their cash. They can return more cash to shareholders through dividends and buybacks. This, by the way, I think is a mistake. I really think it's a mistake for corporations to give more dividends right now. They should be investing more in their businesses, but that's okay. I still invest in some businesses that do buybacks as well. Look at Enphase, for example, which amplify shareholder returns. The S&P 1500 free cash flow is expected to gain 9% this year because of reduced capex. That's fine, but what's that going to do to return to earnings next year? The point is that investors should expect weak demand going forward, but that doesn't mean completely shy away from the stock market. Fine, but what do we want to keep in mind going forward, and where's this CEO Lashup? Well, the first thing that I would keep in mind is, I alluded to it earlier, and I want to just give you my opinion on it. I was initially thinking, okay, Caterpillar, John Deere, but what about ASML? I think because of the CHIPS Act and the massive amount of factories that are going to be built in the next few years, and the fact that there's like a 2-year wait to get a lot of this industrial equipment, I think companies like ASML are actually going to be just fine, thanks to this massive inflationary stimulus checks that are coming to not only electric vehicles, solar, and such, but chips specifically. Well, it's kind of wild, but now I'm starting to get nervous, and not just about staples, but I'm starting to get nervous about industrial manufacturing, equipment manufacturers. I still have hope for aerospace, because in aerospace you still have supply chain lags, but if that catches up, everything's gonna get hit. And as long as we go in the shallow recession, hopefully the growthiest of the companies still do well. But then you also have AI and the, quote, AI arms race. Look at that. It's literally on CNBC right now. The AI arms race, okay? You have them coming for your profit margins as well. It's like, oh my gosh. It's becoming a challenging time to invest, but that's why my opinion is looking for pricing power stocks, PP-style stocks, where you're basically looking at investing in the pickaxes. In my opinion, that's chips and energy. And that's because they're getting the fire hose of the stimmy checks. So learn more about pricing power stocks or other information like my actively managed ETF by going to meetkevin.com, right next to the links for my courses or affiliates and sponsorships at meetkevin.com. Thanks so much.